Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's mission, we are continuing our option series and are targeting in on the put option. The objective is simple: understand what it means to buy or sell a put and how the basic profit and loss works so you do not blow a hole in your account. So, gear up and let's go to work. First, let's do a quick recap from previous episodes. A put option is a contract that gives the buyer the right, but not the obligation, to sell an underlying asset at a fixed price, the strike, on or before a specific date. The underlying can be a stock, an ETF, or an index. If you remember nothing else about puts, remember this: put buyer, right to sell at the strike; put seller, obligation to buy at the strike if assigned. Everything else, profit, loss, and risk, flows from that simple contract. First, imagine you are the buyer. This is called a long put. As the buyer of a put, you pay a premium up front, that is your debit. In return, you get the right to sell the underlying at the strike before expiration. You want the price of the underlying to go down, ideally well below your strike minus the premium you paid. Just like with calls, a put's price has two parts: intrinsic value, how much the right is worth right now, and time premium, extra value based on time and volatility. As a general rule, a put will be worth at least the difference between the strike price and the current price if that difference is in your favor. For example, your right to sell at 50 when the market is at 40 is worth at least $10 per share or $1,000 per contract. That is $10 of intrinsic value. If the put is trading at $11.50, it means $10 is intrinsic value and $1.5 is time premium. As the option approaches expiration, the time premium declines. Why? Because the less time is left, the smaller the chance the stock will make any big move in any direction. If the situation is reversed, for example, the strike price is at 40 and the current price is at 50, your put has zero intrinsic value. If it has any value, it is only time premium. Only in the money puts, where the strike is above the market price, have intrinsic value. Let's walk through a few scenarios. The assumptions are: the stock is trading at 50, you buy one 50 strike put for a premium of 2, and since one contract controls 100 shares, you pay $200 in total. Let's check 3 basic scenarios at expiration. 1. Stock is at 55. Your right to sell at 50 is useless as you could sell at 55 in the market. Pretty obvious. The put expires worthless. Your end result is you lose the entire 200 premium, which is also your maximum loss. 2. Stock is at 48. Your right to sell at 50 is worth about 2 per share, so total value about 200. That roughly matches what you paid. Your end result, you're in break-even territory, ignoring fees. Your break-even price is strike minus the premium. In this case, 50 minus 2. Number 3, stock at 40. Your right to sell at 50 is worth about 10 per share. Intrinsic value is around 1,000, and since you paid 200, your end result is about 800 profit, which is a large percentage return compared to the capital you risk. From those examples, we can see the basic shape of a long put. Maximum loss is the premium you pay, 200 in this example, and your upside can be large if the stock moves strongly down in your favor. Long puts can be used in 2 main ways. As a directional bearish bet, you expect the price to fall and want to profit from that move, and as a hedge, you own the stock or portfolio and buy puts as insurance against a drop. What does a hedge mean? In simplistic terms, you want to offset the loss in the portfolio with the profit from the option. In both cases, remember, as a put buyer, you are fighting both price and the clock. If the price doesn't move down fast enough, time decay will eat away your premium. Now flip the perspective. Imagine you are the seller. This is a short put. As the seller of a put, you receive a premium up front, that is your credit. In return, you take on the obligation to buy the underlying at the strike if the buyer exercises or you are assigned. You want the price of the underlying to stay at or above your strike or at least not collapse far below it. Let's use the same assumptions as in previous example. Stock is trading at 50, you sell the 50 strike put for 2. This time, instead of paying the premium, you receive $200 in premium. To emphasize again, selling the put at 50 means you as the seller have the obligation to buy at 50 and the buyer of your put has the right to sell at 50. Now let's go through scenarios at expiration. 1. Stock stays at or above 50. The buyer's right to sell at 50 is useless as they can sell at or above 50 in the market. The put expires worthless. Result, you keep the 200 premium as profit. 2. Stock drops to 40. The buyer's right to sell at 50 is very useful as the market price is way lower. In this case, you may be assigned and you must buy 100 shares at 50 even though the market is at 40. On the shares alone, you are down about 10 per share or 1000, but you did receive 200 in premium, so your effective loss is around 800. So, as a short put seller, your maximum profit is limited to the premium you receive, 200 in this example. Your potential loss can be large because the stock can fall a long way even if it cannot go below zero. Some traders use short puts as a way to get paid to wait for a lower entry price in a stock they actually want to own, but that only works if the position size is reasonable and they are truly willing and able to buy the shares at the strike price. Let's go through a simple case study. Same as in the previous episode, graph next to the option chain helps you better understand the dynamics of put buying. Assumptions are you are a put buyer of Chevron January 16 put option, strike is at 150 and the ask is 355. Remember, you are the buyer of a put and as a buyer you pay the ask. Calculate. How much will you pay for the contract and what is your maximum loss? What is your break-even price? What is your maximum potential profit? Now pause the screen and try to answer those questions or read them from the graph. Now let's walk through it together. If you are thinking the graph looks like a mirror image of a long call, you are correct. That makes sense as you know the put option is a bet for the stock price to move in opposite direction compared to a call option. Buying a put means you are predicting the stock price will decline and therefore your profit goes up as the stock price goes down. Similar to the call option, your maximum loss is capped at the amount you paid for the premium, hence the flat line. The line remains flat until the option starts gaining intrinsic value. Remember, for long puts, that means the stock price is below the strike price. Once the intrinsic value reaches the amount we paid for the premium, we are in break-even territory and everything from there on is profit. Let's quickly go through some traps that ambush many retail traders when it comes to puts. Buying puts as a constant crash bet, bleeding premium month after month without a clear thesis, timing or exit plan. Loading up on puts during panic when volatility and premiums are already extremely high, making protection very expensive. Selling cash secured or naked puts without fully understanding the worst case scenario, how much stock they might have to buy and how much capital that ties up if stock really falls. Using puts without connecting them to an overall position sizing protocol and portfolio plan. Puts are powerful defensive and offensive tools. Used correctly, they let you protect or attack on the downside with defined risk as a buyer or earn premium with sizable but controlled risk as a seller. Used blindly, they can turn a dip into a disaster. Puts are tools for defense and controlled offense on the downside, not panic buttons or magic crash tickets. A put option lets you prepare for bad scenarios as a buyer or get paid to potentially buy lower as a seller, but only if your sizing, capital, and plan line up with the obligation. You now have a clear picture of put options. Long puts versus short puts, where the profit and loss comes from and where the big risks hide. Since the next episode will be released at the end of the month, we will do the monthly wrap and see how the accounts performed in January. If you found value in this mission, lock in your support by liking, subscribing and following our movement. Thanks for standing watch with me today and until next time, trade smart, risk sharp and stay on target.